Fabulous. Thanks, Jess. Good morning, everyone. Great to see some familiar faces on the webinar, as well as some new ones. Always good to see people engaging with these webinars that we offer to help educate and inform. As Jess mentioned, I'm joined with Claire today to help field any specific advice questions. But without much ado, let's tick off a little bit of housekeeping. This presentation is for information and educational purposes only, doesn't constitute any financial, legal or accounting advice. Obviously, as those who are joining will be aware, we are authorised and regulated by the FCA at the address given, and if in doubt, obviously give Claire or the rest of the team heads up to seek some advice. Today, what we're looking to cover is what a structured product is, as well as the various different products that are out there in the market. There's quite a few different types, so we'll tick those off one by one, as well as why would you use a structured product, which is very much where Claire is very helpful for. After all, she meets with you guys on a regular basis, so is very much more familiar with the usage cases and areas where these are particularly beneficial. Then we'll take a look at key aspects of structured products, which is the degrees of market protection. One of the great things about structured products is that they do help increase your degree of market resilience, let's say. So it enhances the protection for in downward markets, but there's various different levels of protection there, so we'll go through that, as well as some example scenarios, just to help cement a little bit of what we will go through, and then finally, obviously, at the end, we'll summarise with some key considerations. So, summarising right at the top, what is a structured product? So, very simply, a structured product is a contracted investment with a defined return set out within the contract based on the performance of an underlying separate asset. So a very basic example would be, for example, if FTSE 100 finishes at its starting point by the end of the term, the product will pay out, for example, 10% per annum over that period. The contract is made with a financial institution in the form of a loan note. As a result of making that contract, obviously you accept a bit of counterparty risk. After all, you are lending money to a bank. And that's a key part of what we have to do here, is making sure that the products that are offered are appropriate for the pricing coming from the institution, i.e. are they offering a high enough interest rate based on their creditworthiness? Although I gave the FTSE 100 as an example, it could cover all manner of things. So it could cover whole indexes, as I said, like FTSE 100, S&P 500 for the US, Euro Stocks 50 for Eurozone, as well as there's starting to be more Nikkei-based ones for Japan. It could also be bond-based, currencies, individual shares. You can actually have a structured product on practically any kind of financial asset. So they can be very, very bespoke in nature. However, the ones that we tend to offer advice on tend to be tied to FTSE 100 and another index, perhaps, such as the Euro Stocks, if you wanted to diversify a little bit of where your exposure is coming from. As I said, payoff and level of capital risk can be predefined. So, as said, it would depend on what the terms are. So, not necessarily need to be above the starting level. They can be defensive, so that if they are more than 65% of the starting level, you still generate a positive return, which is one of the attractive things that can happen with a structured product, is that you can end up with positive returns, and when the underlying asset has returned poorly, helps add a degree of resilience and diversification within the portfolios being offered. And then, yeah. Claire, did you want to just go over the usage cases?
Sure. So where structured products can be really useful sort of within portfolios and, you know, in different stages of your life, you know, they can act as a cash alternative. So, you know, if you've got a fixed, you know, a long fixed term that you know you don't need that cash for, they generally do, you know, outperform cash for, you know, deposit protected plans. So you can look at them as an alternative there. The most common sort of scenarios we see them with clients, and the advice I give is, you know, in pensions, so they can be held within your pension wrapper. You know, they can obviously underpin that level of performance that you are targeting. They do also sort of dampen the volatility. So, you know, the valuations of these products through the term is, you know, is generally a lot less volatile than, you know, a straight equity-based investment. Also, you'll see at the end, I've got some examples where we can actually define income. So, you know, if you are looking for a specific amount of income, you know, you can target a structured product that pays that amount, and you know that you know that income could be guaranteed for a specific term. You know, there's also conditional income plans if you're comfortable with the risk. In the most cases, though, we generally use them for diversification. So diversification across, you know, a large portfolio that may be in one or two wrappers. So let's say pension and ISA. You know, generally you would hold a market-based portfolio, so funds, you know, funds in ETFs and investment trusts. You can also, you know, alongside that, have these structured products sitting there. So, you know, in big market events, you know, you are diversified away from that. You can be fully protected against market volatility. They also can be added to a very, very defensive focus. So, you know, we can have growth products and we can also have very, very defensive products. So if your risk appetite, you know, is getting lower, you don't really want the volatility, you can't take it anymore, because for a number of reasons, they actually can act as a defensive asset, which, you know, the capital can be guaranteed. So those are the kind of main areas we see them. Obviously, what's coming up in the budget, we may see them more prominent in, you know, ISAs, for example, if people are looking for, you know, a tax-free income stream. You know, a structured product can provide that if you wrap it within, you know, if you have the tax wrapper surrounding it. But yes, you know, lots to be seen next week where this might change. But, you know, the generalized sort of strategy there is underpinning performance and dampening volatility, and diversifying away from, you know, one set of portfolios. So yeah.
Fabulous. Cheers, Claire. So Claire covered quite a few types of structured products there. Just to summarize that up, so we kind of have at the top level two different kinds. You have a capital growth product, so, and separately an income, and this also applies to the type of taxation that would come from the returns on these products. So at a most basic of these is perhaps the at the money capital growth product. So so long as the underlying asset is at the same value at the end, on the observation date, as it is at the start of the plan, it generates the positive returns that are defined in the contract. Do come across, though they're not quite as commonly used, do have products which require a growth, so 105%, 110%, etc. of the starting value to generate those figures. But as I mentioned earlier, we also have those defensive products. And I seem to recall, Claire, that we had, I believe it was Tempo structured products a couple of years back, but on a couple of their plans, it was as low as on observation dates, 55% of the starting level to generate positive returns by the end of the 10th year, which historically, a decline on a broad index such as FTSE 100 to decline that much would be an incredibly poor market environment. So, you know, there is definitely different areas that we can be in aggressiveness. Obviously, the defined returns depend on the level of risk involved. After all, there's no such thing as a free lunch. But if those generate a positive return, is deemed to be capital growth, and the taxation that comes out of that is capital gains tax, unless of course it's in a tax efficient wrapper, in which case those rules apply. There's also income plans as well. So these are quite nice in the sense of you don't get the return all in one lump. It can actually help smooth a degree of the returns. So what we'll cover in a minute is that so long as shown there, so long as the performance of the underlying asset is above the observation point, you will get an income payout in the middle of the plan length. So you could end up with a situation where, although at the end you might end up with a capital loss, because you've had income payments along the plan, you end up mitigating some of that capital loss at the end. However, of course, it's very much beneficial in pension retirement planning. You know, it helps, you know, make sure that you can determine what kind of income there's going to be available within the plan over, say, some of these plans are 10 years in length, so it helps add a degree of stability within the portfolio. Some of the more advanced plans of income types have a memory feature. So what that means is that although you may not end up with an income being paid on one observation date, it is in essence saved up. And if another observation point generates an income payment, you'll be back paid all the ones that haven't been paid out up to that date. So that adds, again, another degree of stability within the returns of that product. I covered the underlying investments that can be there. Individual companies, single or dual index are probably the more common ones. But every now and then you will see things like Brent oil crude being on there. What I would say about those kind of products is that when they come to market, you're better off actually just buying the underlying investment rather than the structured products. It's just because the pricing's become very attractive at that point. But those two we tend to find are the most beneficial for our clients over the longer term. So degrees of market protection from market movements in a downward environment is very important with structured products, and there's two different styles that this can occur. To be honest, one is pretty much extinct within UK retail investments structured products now, which is the American type, which is quite good because it's left us with what is by far the more safe option for retail investors, which is the European market protection now, which is the observation of the underlying investment only matters at the very end of a plan from the point of view of the capital protection. So what that means is that this is typically around about 60% of the original investment value. So if at the very end of the plan, if there has been no kick out, what's called a kick out, so that's an early positive return payout to you. If at the end that value is underneath the capital protection barrier, which is typically around about 60%, then you would end up with capital at risk of loss. Above that, however, you would receive back the full amount that you were investing, which, as I said, that capital protection barrier is typically around about 60%. So typically you could end up with a 40% decrease in the underlying market movement for the moment that you put your capital in. However, so long as it didn't fall any further over the remainder of the plan term, say 5 years, etc., you'd still end up with at least your capital back, just based on market movement. So that's what I mean. It gives a high degree of protection within portfolios from market movements, which could be very beneficial. Just very quickly, the American differs from the European in that if the underlying market value went underneath that barrier level at any point during the planned term, the capital would be at risk. But as said, that isn't really done very much anymore now within UK structural products. We only care about the value right at the end, and tends to be very much safer for investors. Obviously, though, you increase the amount of protection, you reduce the amount of potential returns, and it's very much about making sure that we are advising what is perhaps the best value for money products to you, our clients, to help you achieve your goals. And that's just an illustration showing what I just showed there. If it dips underneath halfway through the term, the American barrier, would mean that you're at risk of capital loss. However, in the European style barrier, because they're right at the end, it is above the protection barrier, you're at no risk of capital loss from market risk. Did you quickly want to go over deposit plans, Claire? I know you advise quite a bit on deposit plans.
Sure. So deposit plans, as I sort of alluded to, you can use these as a cash alternative. So, much like you could have, £85,000 with NatWest, for example, in a savings account that has a fixed rate of return on an interest basis. You can also have that same underlying protection, i.e., no risk of capital loss on a deposit plan. So the reason I say there's absolutely no risk of capital loss is because, there is no market risk. There will be no end of term barrier. So there won't, in a deposit plan, you would never see the terms American or European barriers. There will be a defined level where the return is generated, and there will also be, a term on it and a fixed rate of return. So deposit plans can be income, they can be, they can be growth focused. Deposit plans pay their returns in the form of interest. Literally, if you do think of them like a cash alternative, you understand sort of that flow of taxes. So even if it's a investment gain, it is paid to you as an interest payment. So these plans are, generally on the lowest risk end. So they are the really, really defensive options. The reason they're attractive now is because I guess, we're all expecting interest rates to come down. So it's pretty hard to get anything more than, a 2-year fixed term cash investment, at anything above 4.5%. So these style of plans generally, have 3 to 7 years on the term. As I said, they can pay income throughout that, so you can realise your interest payments over the course of the term, or they do accumulate and run the full term. Which there'll be some examples of them, but yes, they are fully FSCS protected. Obviously up to FSCS rates, so per financial institution. Another thing why they're quite attractive and nice for, clients that are holding lots of cash is because the deposit taker is usually someone like, SocGen, Royal Bank, RBC, banks like that you generally wouldn't, approach on the high street. And, you wouldn't have your everyday money there. So, obviously with that 85,000 per institution, it's very easy to, spread that out with a portfolio of structured products. So yeah, that is a deposit product in a nutshell. But yes, generally, they will definitely have, a lot lower returns than the investment products, just because there is no market risk and there's no counterparty risk. So you don't, like, those two things have completely disappeared when we talk deposits.
Yeah, I think circa for a deposit plan, you're talking around about a 5% per annum return for the market to basically be at the same level as it started. Whereas with a capital at risk plan or an investment plan, that figure's more like 10 or 11% per annum. So there is quite a bit of a difference between the two, but obviously you'll pay for that quite a lot more, the increased protection that you have, both from a credit risk standpoint, because obviously you're covered by FSCS protection, but also as well from the fact that you have no market risk, downward market risk at all with these products. So just looking at the current market, what are we seeing? So as you would perhaps noticed in July, August and last month, there has been spikes in volatility that have occurred at various points. What you tend to find is because of how the underlying investments are priced, when that happens, that helps pricing to move up. So we are seeing this month, we are seeing around about 0.5 to 1% increase in the rates being offered, which is of course very positive. We're actually past peak interest rates for the cycle. So that is affecting to a degree all products moving down for obvious reasons in terms of their potential returns being offered. They're still very good based compared to returns over the last 5 or 6 years, but they have moved off of that peak. That's not to say that now isn't a good time to get one. It's just that the potential return being offered isn't as good as it was, say, 12 months ago. Uncertainty feeds into increased volatility. Of course, at the moment, we've got a UK budget coming up next week. We're certainly seeing an increased risk premium being priced into gilts at the moment, which is what these plans typically are based off of in terms of their spread over and above. So that has helped elevate the price, as I said, of all of these products up for a shorter period. The next month or so is probably going to be fairly good for rates being offered. So, quick worked example. You have to excuse the dates. I had to go back in time to find a good example where I could talk about all the different scenarios that could play out. So what we see here is that the strike price, so that's the starting price of the plan, was around about 7,250 in this hypothetical scenario. The plan runs over 5 and a bit years. And during that course of that, we have 5 observation points. So what we see there is at the first observation point, during this as well, there's a contingent income being paid out, which requires the plan to be above around about 6,700 to pay out the income associated to it. So what we see there is that over the plan, the first 3 instances of observations, the FTSE 100 is over that contingent income level. So we'll be paying out an income to you. Typically on income plans, they pay out quarterly, and at the moment the rates being offered on the plan like this would be around about 9% per annum, just under. So you would receive those income payments through that period. What we'd see though after that third observation point there, when we go into 2020, COVID feels a very long time ago now when I'm looking at this graph, is that obviously we'd gone under the hypothetical European protection barrier. This is what I was talking about. If that was an American protection barrier, it would then mean that the capital would be at risk for market movements at the end of the plan. However, because this is European, all we're matters about is where that sits at the end, and it recovers well above that capital protection barrier. So in a situation where none of the observation points were hit thereafter, you would still end up with 100% of capital back as it finished over the top of capital protection barrier. What we see there in 2021, however, is that at the observation point, the FTSE 100 sits just underneath the contingent income level. I really should have used several different colours on this. I just realised how all of my lines are the same colour and therefore not very clear, so I do apologise. See that the FTSE 100 is just underneath the contingent income level, so it doesn't pay out on that one observation. What we would see with a memory plan is that income, in essence, is reserved for if it then gets hit on a successive one. If it didn't have a memory feature, in essence, you'd lose your rights entirely to that one income payout. But then we see on that final observation there, we hit above the contingent income level. So if the income gets paid out for that one time period, and then if there was a memory feature, you'd also get the previous income paid out on that date as well. So there's various different ways that this could work here. As seen at the end there, we're above the capital protection barrier. So the investment holder received all of their capital back plus those income payments. Same philosophy works on capital growth products. Obviously, instead of income, it's determined when those the plan will pay out with the increased rates, but it tends to be a bit more of a complex graph, and try to keep this a little bit more simple for purposes of this call. Did you want to come?
Yeah, sure. Cool. So this is, I guess, just real life examples, trying to put this into perspective and into, a reality for everyone. So if we had this hypothetical plan, that pays income at 6% per annum, it is in force for 6 years. This plan, you can see, it's in force for 9 years. Where the plan starts is, that 6,500. This contingent income line is the purple one. So if we were taking, annual, quarterly income payments from this product, you would have got all of them because we're up above that, unless there was, the week of COVID, the bottom of the market, unless that was an observation point, you would have missed one of those income payments, but, you'd have had all of the returns over the life of this plan, really. So this example, the total return on this plan is 51%. So, one missed income payment leads to, that 51% return. If we, looked at the alternative and, what is the alternative to a structured product, there are lots of different ways you can invest your money, but, in general, we would be looking at, a stock market-based portfolio. So, if we were an aggressive investor, that could be 100% in the FTSE 100. If we did that, your performance differential over that 9 years would be, 46% or 45%. The structured product would have actually paid out returns, and you'd have realised the returns throughout the term of 51%. On the equity holding, the total return would be 5.93%. So that's just an example where, the income plans really can dampen that volatility. This example, another example, but yeah, it's outperforming the market and these products, you can't guarantee that, but in general, depending on risk tolerances and things, we would look at plans like that. So this one is a growth product. So a growth product either needs, the underlying index or underlying asset to be at 100% or above. Some plans are 100, some are 105, some are 110. But, this one is offering a 10% return per annum that the plan's in force. Generally they have a year 2 early maturity. So when you look at the contract, you will have, key things you will have is the strike date, the underlying index, the possible maturity dates, and the end date. and obviously the annualized annual return there. So usually you'll see the first opportunity where you say, will this product mature or not, is on year 2. For argument's sake, I've put year 1 here. So, on the first year's test, the FTSE, being the underlying index, was not at or above its strike price. So, nothing happens to the plan. You don't incur any losses. The plan just rolls over, the plan continues. Get to year 2, we are still not there. So we went above it, but you just dropped below on that observation date. Again, nothing happens to your plan. The underlying value of your plan remains the same. Your capital is still there. On year 3, in this case, I have assumed again we're below it, just to give some extra depth to that. So, we had a big market drop and then we've had another recovery. However, in year 4, when we get there, you can see the FTSE 100 being the blue line there, is above where we started. So the fact that it's above where we started, this plan, the contract sitting behind this plan says, right, that's matured, and your capital gain, your growth is 10% times the years in force. So it would be, it would mature, you'd get your original capital back, and then you'd get a 40% gain. Again, just putting that into perspective, comparing against the underlying index for this period, the FTSE, the total return on the FTSE was 12.53. So again, you have one, dampened volatility, and you have outperformed the underlying index significantly. And I think a key thing in this as well, you actually haven't felt those losses. So when the FTSE or underlying index drops, say if there was a market crash, go back to COVID, it dropped I think 26% or something. If you needed your capital on that day, if you had to sell the FTSE 100, you'd be realizing that loss. Structured products, I guess, they're important to know. There is a secondary market to them, but we wouldn't advise sort of midterm trading of them. We advise them to go in on day 1, and the maximum term is already stated, and you would generally follow that. So this example here, just picking a different timeline to put again into perspective. So the strike on this plan was, up at nearly 8,000 on the FTSE 100. So that being the strike, you've taken a plan, you've taken a really high strike price. Now, you could use that as a scenario. Now you could say, the FTSE is high at the moment. All equity markets are high value, or they are. They have grown this year, I'll say. So, is now the right time to do it. So this style of product gives you a defensive return. So when we look at this product, this one would also have matured in year 4. So the strike price at just under 8,000, that also dictates your capital protection. So the capital protection there is at, is it down at 50%, I think? Down at probably 50% on this plan. So there's 2 scenarios that I can show you here. So if it was a growth plan and we were having a stepping down of the kick out barriers, so you can see the blue to red to green to purple, those are your points where the FTSE would need to be above those points on the corner, and the plan would mature, and you would realize your return. So this one, you can see matured in year 4. So the purple line there, so it matured. The FTSE is over that, over that corner. So that that is down probably at 95, 90, 85%. I'm going to say. So we're above 85% of our initial strike. So you have realised your return of 7% per annum at a total return of 28%. So over that period, from your strike to your maturity, the FTSE has actually fallen 6%. So even though you have realised 28%, your underlying asset has fallen 6%. I've got contingent income on there because it just gives you another perspective on an income plan. So, you know, if you took an income plan with a contingent income, you know, level, you can see that only in a only in the very extreme market environment like COVID, did we breach that. So yes, you know, this plan could be paying income, as Sam highlighted the memory feature, you know, if that, you know, COVID period, so, you know, the year 2020, and we got into 2021, you would be repaid all the owed interest that you've missed in that previous year. But yeah, you know, if you took an income plan and you didn't have the memory feature, there would be a few missed income payments on this scenario. But you know, in general, you would be happy and you'd be receiving your income. So this is you know, just a real life example of a product. This real life example of the product actually links back to the previous graph. So, you know, the timelines line up, well, near enough line up. It's what it was based on. So this one has basically six options for maturity. First one at year 2, as I said. So this plan I'm showing you here started in 2022, July 22. Your first option where you can have a maturity is at July 2024. And at that day, we would have to have, you know, 105%. So we'd have to have 5% growth in the underlying asset to realise your 7.25% per annum. You can see there that it actually drops at 105, 100, 95, 90, 85, 75. So your final maturity, you know, your final barrier to realise gains is at 75%. So, you know, we can have a 25% sustained market drop, or, you know, an event right at the end of this plan, you know, we could drop 20% and you would then still get all of your you know, accrued returns paid. This has a, you know, a barrier of 65%, so, you know, the capital at risk there. But yeah, you know, the more so we call it auto calls, but kick out opportunities, you know, they are your options to realise your returns. So this plan happens to be 8 years. There are some that are 10 years. There are some that are 4 years, but maybe quarterly kickouts. So, you know, something we also assess is, you know, how often is there a test? You know, if there was one at the start and one at the end, you know, you've got one option for the market. You could have a market event the week before your product matures and, you know, not realise any return because there's only one option for that. The more kick-out opportunities there are, you know, the more likely you are to realise your return throughout the life of the plan. So these are current deposit plans. So two options here. So these plans are basically fixed term plans. So the top one there is 3 years and the bottom one is 4 years. Top one is very, very basic. So you have a strike. And as I said, you know, you've got that one option usually with deposit plans. Deposit plans will have a strike and an end. And that is, do you realise your return on the 3rd anniversary or not? If you do, so if the underlying index was above or at or above where you started, you would get a fixed payment of 22% on that one day. The bottom one is just a little more complex. So just adding another sort of option to the product, that this one has a guaranteed minimum return. So this one is always going to repay your capital. So you remember, if you had up to £85,000 in this plan, then, you know, and nothing else with that financial institution, you put your money in on day one, and on the 4th anniversary, you get a minimum of 11.5%. So that 11.5% return is given to you regardless of what happens. You know, and you haven't claimed from the FSCS. The FSCS doesn't pay accrued interest, obviously, but yes, you know, assuming this plan is still there on the 4th anniversary, you're going to get that 11.5%. The condition to the other 11.5% is the same as the one above. So are we at or above the initial price on the underlying index? If yes, you get another 11.5. If no, you get your capital plus 11.5. So that is a deposit plan in a nutshell. And yeah, two different types there, because they are generally very vanilla, plain plans. I think the biggest risk with deposit plans is that you possibly couldn't realize any return. So in an environment that we had previously, that was just 1% interest at a maximum on a fixed rate. The deposit plans do look attractive at that, because I guess the opportunity cost of not realizing that return at the end of 3 years versus having a 3% in a bank account, isn't that impactful? But yeah, they can work, and a blend of these products all work really well in a portfolio.
Yeah, cheers, Claire. So yeah, just to summarize, so a structured product is an investment by a contract rather than by sentiment, I suppose you could say, within equity markets. Your returns are defined by what happens in the market rather than variable. We're reducing market risk through these contracts. So obviously they still exist. Otherwise, if you had no risk, you would end up with zero return, or entirely deposit cash-based return. There is a degree of credit risk involved, because obviously you are taking the contract out with a financial institution, and that's one thing that we have to do is evaluate whether the rates being offered by the institution match their credit standing. It's rather important not just to diversify this as a diversification within your portfolio, but also that we diversify different types of markets, so that your spreads in that kind of regard. Also make sure that we diversify your credit risk, where you're not in a deposit plan and FSCS protected. And as Claire has very comprehensively covered there, many types of investments there to suit many different goals. As I'm sure you can appreciate, this is such a very different set of offerings that can be given to you that is hard to cover within 45 minutes. But what I would say is thank you very much for joining us. And if you've got any questions, email Claire or your financial advisor, or phone the team to book a meeting in, and we very much look forward to hearing from you.
Lovely, thanks guys. So we don't actually have any questions at the moment, so I will go ahead and pop the survey up in a second, just to let everyone know. So if you've signed up to this webinar today, you will receive a copy of the presentation, slides, and also the recording, so you can go back and look at it at your leisure. If any other questions, like Sam just said, do pop up from that, obviously do reach out. We normally try and get those out to you within the next 24 hours, so we will look out for them in your inbox. Still no questions coming through, so I'll pop the survey up. I'll leave it up for about 5 minutes. If you can just take some time to fill that out, that would be really helpful. And yeah, we'll catch you at the next webinar.